Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is Michael Gray. And Michael started on Bay Street in 1962, the year I was born, and he now runs his own investment counseling firm. I've asked Michael here to talk about some of the biggest mistakes that investors make. Michael, what's a big mistake you see investors making?
Rob, the biggest one every day of my life, the markets are bad, the markets are down, I've lost money in the markets, therefore I can't really invest right now, think about anything right now. I'm like a deer frozen in the headlines. Where the truth is, you haven't lost money in the markets. You've still got the same investments, carefully selected, working out for you, delivering the same dividends, same earnings, higher dividends next year, doing all these things for you. What has happened is the group of speculators and hedge fund traders and private equity group and whoever who make up the markets, marked things down, took it in their heads to mark things down. What you should be saying is, hallelujah, we can buy more, this markdown sale in the markets, but you don't get it that way. So that's one. And then there are times when you must take your losses. You must accept that circumstances have changed. Nortel would be a classic example in point. Face up to it and take it. Don't linger, take your losses.
It sounds to me that you got two mistakes there. One, investors get too obsessive about down markets, and two, they're too reluctant to sell. Now, what are some other mistakes? Portfolios I see every week of my life, they obviously no plan. It's a jumble, and I must look them in the eye and say, you know what, you're not going to have enough here. You're going to run out of money before you run out of life. There's that. Portfolios with way too many holdings. And I like 15, 20 holdings. Each holding in a portfolio must be meaningful. And if you have 40 or 50 and you have something that doubles or quadruples, but it's just a teensy part of the portfolio, the overall impact is nothing. So discipline yourself. Each holding must be meaningful. And if one looks better than another one, then toss that one out and put the other one in, but keep 15 to 20 maximum. Stocks, equity positions, they could be fund holdings, products as well. Keep it small and keep it simple.
Yes, and then lastly, Rob, the understandability. Mr. Buffett, Warren Buffett, must understand. The investor must understand what they're investing in as well. Not these esoteric things. They really don't know. Their broker said buy them, or somebody else suggested they don't know what they are. Understand what you're doing. Not in intimate detail. That's your job and my job. But understand what you're doing.
That's great advice. Thanks, Michael.